Welcome to the APW Partners Quarterly Market Update for 30 June 2023. Joining me today is Dr. Steve Garth, who's recently been appointed an investment consultant to the APW Partners Investment Committee. For nearly 20 years, Steve worked for Dimensional Fund Advisors, where he managed many of the strategies that our clients are invested in across Australia and global, and also the entire suite of fixed interest solutions. So Steve brings an extensive amount of experience across setting asset allocation policy, managing and also evaluating client portfolios through time. So it's great to have you on board, Steve.
Great.
Welcome.
Thank you, Dermot, and it's great to be here too.
Fantastic. Well, it's been a really fascinating start to the year, hasn't it, really? I mean, a lot of the expected things that we saw at the start of this year around central banks continuing to increase interest rates in the face of rising inflation and trying to corral that inflation, and obviously the fallout being that economic growth has started to really fall in that environment. But separately to that, we've seen equity markets in particular really shrug aside a lot of those concerns and post some pretty strong numbers, haven't we? So has that really played out here in Australia as well?
It has indeed, and you're absolutely right. At the start of the year, I think we were expecting that it was going to be tough times in the stock market. We knew that inflation was still sticky and that interest rates would go up. But have a look at this chart here. It shows the Australian stock market over the last 12 months, and you can see that it's up 14.8% over the last 12 months. So that's a very strong return. The other interesting thing about that chart, Dermot, is you can see the volatility, which is, a measure of fear, if you like. It's actually going down and down and down. It's as low as it's been for years. So markets are going up and volatility is going down.
How does that compare in international markets?
Yeah, let's move over to the global markets. We'll start with the developed markets, and the biggest bit of developed markets is the US. They're about 65% of the developed markets, and Australia's like 2%.
Yeah.
But you can see that it's a very strong half-year return, 17.5% for developed markets. And the US, particularly strong, up over 19% there. But also Europe and Japan. This is a very broad rally across countries. Now, emerging markets not doing as well. The reason for that, Dermot, is something about 30% of the emerging market index is in China. And despite China shaking off the post-COVID lockdowns, the economy really hasn't started moving the way investors thought it would. So they're a bit of a laggard compared to the developed markets.
Yeah, that's right. And I think obviously on that front, the US tech sector seems to be some of those big names that we all know all too well that struggled actually last year, posted some really strong names this year. Is that what's driving a lot of the standout performers in the US market, obviously outpacing a lot of the other developed market returns?
Yeah, that is absolutely right, Dermot. If you look at the US actually in isolation for the moment, as we saw, it had the strongest return, really sort of driving that world developed market index. But in the US, it's really split between two exchanges. One is the NASDAQ, which everyone's heard about, with about 46% of the US market, and the other one's kind of the older New York Stock Exchange, and that's about 54% of the S&P 500. And you can see in the chart here that the NYSE is kind of not doing very much at all, but the NASDAQ is just up and away. It's up about 30%. To your point, it was down 30% last year, but it's fully recovered from that position now. What's sort of alarming some commentators, though, is that it's not a broad-based recovery in the tech stocks. It's actually just down to 7 stocks. They're called the Magnificent Seven. And, I won't go through them all, but it's going to start with Apple and Microsoft at the top. And then a company which I think most Australians had never heard of up to about a week or so ago, called NVIDIA. Now, they make chips. And with the craze for AI-related technologies, it's only going to function with chips. So this is a chip maker. They're up 180%. Year to date. So that really is driving the US market, which in turn is actually driving the global markets, but it is a narrow rally in that sense. It's quite concentrated.
And Steve, when we come to bonds, obviously the chief factor around interest rates and inflation is what bond markets are influenced by there. Are we at that point where central banks are going to stop raising interest rates on the back of inflation rising? Are we at that time where they're going to pause or maybe even look to cut towards next year? And what are the bond markets telling us they're going to do?
Well, the bond markets are certainly telling us that we're close. We are expecting a little bit more to come. And it is sort of putting the bond market off a little bit. So while the equity market seems to be rejoicing in the fact that we're nearing the end of the interest rate cycle, the bond market, the yields keep going up. And of course, yields are inversely related to prices. So unfortunately, we're not seeing that great recovery in bonds that we may have been expecting. But, you can see in the chart there that as the yields are going up, that the returns are quite muted. In fact, global bonds have got a small negative return for the quarter.
It's interesting looking at the sentiment and how the analyst expectations have changed just on that very point, Steve, over the last 3 months. 3 months ago, the chance of a recession, or at least what markets were predicting would happen towards the end of this year, particularly in the US, was that it was extremely likely. And now I feel like the language has softened somewhat and that the chance of recession is not necessarily a fait accompli.
But you're absolutely right. Sentiment has changed, and it's now more likely that there's going to be a soft landing. But we're still getting these mixed messages where the equity market seems to be very excited, and the bond market actually seems to be quite, depressed, going, hang on, there's still going to be an economic slowdown coming.
And time will tell whether that's temporary or whether that's...
Time will tell, but there's definitely mixed messages going on in the market.
And to that point, there's a wonderful article on our website that talks to that very point in a little bit more detail, looking at those mixed messages that the equity and bond markets are signalling and how to interpret some of those messages, I think, moving forward in terms of how to look at the portfolio and moving forward for that matter. So thanks for that, Steve. I think that's a really good summary of the events that have transpired over the last quarter. And just rounding that out, looking at our investment philosophy as well, we just wanted to revisit some of the core aspects of that. We know that we need to focus on the importance of long-term capital growth, and when we do that, we can do that through an evidence-based approach to managing money. We need to diversify broadly across securities and asset classes and markets to reduce risk and excess volatility through time. And we need to focus firmly on the factors within our control, which are harder to do, particularly in today's landscape and the environment and everything that's going on. So thank you, Steve, for all your insights, and thank you to those who have joined today. And we look forward to seeing you again next quarter.
Yeah, terrific. Thanks, Dermot.
Thanks, Steve.